Ever wondered how some stocks double their value in a short time? Well, welcome to the intriguing world of stock investments. This is a place where fortunes are made and dreams come true. But it's not all about luck and guesswork, oh no. It's about understanding the game and playing it well. Let's take a step back and look at the grand scheme of things. The market, as represented by the S&P 500, has historically given us an average annual return of around 9%. Not too shabby, right? But what if I told you there's a way to potentially do even better? Enter the realm of growth stocks. These are the mavericks, the high flyers, the stocks that have the potential to double their value in a shorter time frame. But before you get too excited, remember that with great potential comes great risk. These aren't your average run-of-the-mill stocks. They're like wild stallions, full of energy and promise, but needing the right guidance and understanding to truly shine. So do you want to know the secret behind these growth stocks? Stick around and you'll be in for a treat. Now you might be thinking, what's the key to a stock's growth? Well, my friend, it's the almighty revenue growth. Let's take a trip down memory lane and have a look at Amazon. This behemoth is a shining example of how consistent revenue growth can lead to a stock's success. Although its bottom-line performance was quite the roller coaster ride, Amazon's relentless revenue growth consistently propelled its stock upwards. But here's the catch. While revenue growth is a vital part of the equation, it doesn't automatically guarantee that a stock's value will double. It's a bit like baking a cake. Sure, flour is important, but it alone won't give you a mouth-watering dessert. You need the right mix of ingredients. In the same vein, a company's revenue growth is one of the key ingredients for stock growth, but it's not the whole recipe. There's more to the story. You'll need to consider other factors such as the company's valuation, potential for profits, and how it stacks up against its peers. And let's not forget about exceeding analyst estimates. It's like the cherry on top of our metaphorical cake. When a company surpasses these expectations, it can provide a nice little boost to the stock's value. But remember, investing is not a sprint. It's a marathon. It's about being patient, doing your research, and understanding the complexities of the market. But don't go running off buying every stock with rising revenue. There's more to this tale, my friends. All right, so we've got revenue growth. But is that enough? Nope. We also need a reasonable valuation. Let's take a little detour down to Snowflake Town. This tech giant experienced strong revenue growth, but guess what? The stock price fell. Why? Because its valuation was as high as a kite. Just goes to show, a company can make all the money in the world, but if the valuation doesn't make sense, your stock's not going to be the belle of the ball. You see, a high valuation implies that investors have high expectations for a company's future earnings. If these earnings don't materialize, the stock price can tumble faster than a tumbleweed in a Texas twister. So, while revenue growth is like the juicy steak of a stock, valuation is the sizzle. You need both to make a stock mouth-watering enough to double its value. Now, let's talk about balance. Think of revenue growth and valuation like the two sides of a seesaw. If one side is too heavy, the seesaw won't work. The same goes for stocks. If a company's revenue growth is strong but its valuation is too high, the stock won't be able to double its value. Conversely, if a company's revenue growth is weak but its valuation is low, the stock also won't be able to double its value. The key is to find a balance between the two. Remember, a high-flying stock without reasonable valuation is like a cowboy without a horse. It might look flashy, but it's not going anywhere fast. So what's the secret recipe for a stock that can double? It's a pinch of revenue growth, a dash of reasonable valuation, and a whole lot of patience. Well, let's take a quick stroll down memory lane, shall we? We've learned that investing in growth stocks can lead to significant returns, with the potential to even double your investment. But we've also seen that this isn't a simple buy and forget kind of deal. It's all about the balance between consistent revenue growth and a reasonable valuation. Take Amazon, for instance. Despite its roller coaster ride of bottom-line performance, the company's consistent revenue growth has been a key ingredient in its success. On the other hand, there's Snowflake. Despite strong revenue growth, its high valuation has seen its stock price take a tumble. And let's not forget, patience is the secret ingredient in this investment recipe. We're not looking for a quick buck here, we're playing the long game. It's about spotting the potential and then having the patience to let it unfold. And there you have it, folks. The secret sauce to doubling your stocks. Remember, investing is not a sprint, it's a marathon. Now go out there and make some smart choices, or better yet, stay and watch some more of our videos. Either way, happy investing.